What if market crashes were your biggest opportunity? I've been trading and investing for 18 years, longer if you include my teenage years trading demo accounts, and the dream of explosive returns that would change my life kept me coming back. The truth is, most of the promises you see of how I turned $1,000 into $1 million by trading on platform X are rubbish, but I kept learning, trying, and getting better. 5 years ago, everything changed. I found 3 simple numbers that turned market crashes into $2.745 million of life-changing wealth. In this video, I share how I used it and what the results were so that you can make wiser investments. Again, I can share it confidently because it's how I grew my $250K of savings into life-changing wealth. Quick disclaimer, this is not financial advice but guidance. 1. Growth. Fast-growing companies are market darlings, and in good times, euphoria sends them soaring. Unfortunately, when the market crashes, they also get hurt the most because the emotional swing from euphoria to panic is so great. And when market sentiment is negative, there's suddenly an army of people talking about why things are bad and can get worse. But if you keep a clear mind, you'll notice that these are irrational emotional arguments just as much as they were irrational euphoric arguments when the market was at its highs. It's the same companies, and now that the market has smashed everything, you can buy into the best ones at huge discounts. Often, sanity returns when a company releases results. And if you've been following it closely and have no reason to believe that its health has suddenly changed, then you know when the panic is likely to dissipate, and you have a time frame within which to buy. Take SoFi. It was valued at $10 per share, but when it first traded publicly on 1 June 2021, it opened at $20.15 and immediately rose to $22.65 on market euphoria. SoFi was indeed a fast-growing fintech company, but the market more than doubling its valuation in the space of a few months was clearly euphoria and a red flag. 2 years later, tech crashes. None of this is SoFi's fault, but its stock price too is smashed from the highs of nearly $30 to around $4.34. Since it's the same company and still fast growing, I bought it when the stock dropped below $10. Over a few months, I averaged in with the final price being $6.75. Today it's around $12.70 for a return of 88%, and after 5 years of continued growth, there's no reason to believe the price can't go much higher. I have a larger thesis about why finance is undergoing disruption by fintech and crypto, but that is a topic for another video. Bitcoin's another example. In 2021, Elon's hodl tweets and Tesla's buy-in fueled the frenzy. Again, holding off in euphoria saves you when that regular visitor, the market crash, comes. While there is no specific growth number for Bitcoin, I use the number of individual wallets as a signal to its growth. Since it's continued to reach new highs in 2022 despite the crash, I bought it at $19,000. Today it's $96,000 for a 5x return in 3 years. Growth shows you what's real. Crashes hand you the deal. But a market crash can kill a company that would have grown strongly during normal times, which is why the next number cannot be ignored. 2. Cash. Market crashes are brutal stress tests that entire sectors and sometimes the world goes through. It's how poorly built companies are pruned, and those who survive thrive. A crash can mean no support for those who struggle. They can't raise money by selling shares or borrow to survive. So if they don't have enough cash to weather the storm, the company will probably die. It doesn't matter how well they might have done during good times. This is how Lehman Brothers, a 158-year-old investment bank, collapsed. In 2008, a global financial crisis created short-term losses for the bank. Unable to borrow money, it filed for bankruptcy. So I found it critical to look for companies with enough cash to survive a downturn, without needing to borrow or raise funds at the worst possible moment. Take another example, Tesla. In 2019, its stock price crashed. Talk amongst Wall Street analysts was rife that the company needed to raise new money to survive the year. I'd been following Tesla for a while. I knew they were making great products and believed that a successful launch of the Model 3 would change the game for them. Also, Tesla had just raised cash on May 2 in 2019. This helped hammer the stock with many questioning that it won't be enough. I gave them the benefit of the doubt when Elon said, "This is not because we need to raise money to survive. It's to give us a bigger buffer and reduce risk." It's the smart thing to do. So I took the risk and bought at $15.80 in June. Within months, the stock explodes, nearly doubling, which leads me to the third number, profit. When Tesla results came out on September 23 in 2019, within hours the stock price climbed 24%. It reported a surprise profit. Instead of the market worrying about Tesla raising new money to survive, it was suddenly generating profits, cash, and growth, and within a year the stock price 10x'd. That's the power of growth, cash, and profits. Palantir's another gem. For years they've been profitable, growing with sufficient cash to last them through tough times. In 2022, their growth slowed at the same time as the rest of tech crashed, and their stock price sank below $7. That was down more than 80% from its peak less than 2 years earlier in January 2021. Since they remained profitable and had sufficient cash to weather the storm, I bought it at $9.26. Today it's at $124.53 for a 13.44 times return in 3 years. Of course, not everything works out. Block, formerly Square Capital, was the other fintech I bought in 2022. Growth and profits had dropped, but it had sufficient cash to get through the storm. As the stock crashed from $276 to $51, I bought it at $68.27. The former years of high customer and profit growth have yet to return, and today it's around $46, down 32% from where I bought it. But the key lessons are that markets reward profits and growth, or punishes the stock if it disappoints. And if a company does not have enough cash to get through a tough time, the market will kill it by crashing the stock price and denying it loans. This may seem obvious, but the market regularly goes through periods of euphoria on promises about the future or panic for fears of it. This is what happened to Rivian and Nikola. Rivian went public at $78 a share. The price doubled to more than $170 on promises that it would be the next Tesla in the electric vehicle revolution. At this point, the market valued the company at over $160 billion. But when the reality check came in the form of a market crash, it dropped more than 90%. That it needed to raise new rounds of cash to stay in business has meant its stock price has yet to recover, and today it is around $13.75. Nikola also never reported a single quarter of profit. It didn't have meaningful revenue or a working product. It was always hype and hot air. They were worth nearly $40 billion at one point. Today they're bankrupt. Final thoughts. Stay clear, stay ready. Even now with tariff chaos and the S&P 500 down 10% in a couple of months, we may be in the early stages of another market crash. But if you stick to profitable, growing companies with cash to endure, you'll not only survive, you'll find some of the best investment opportunities in your life. If you found this useful, hit like, subscribe, and drop a comment on how you're thinking about the current market turmoil. I'd love to hear what's on your radar. Good luck.